Yeah, we have been preparing for it for a long time, really. We've been 4 or 5 years we've had the portfolio set up for a falling Australian dollar. So it's good for us to see it finally happen. And I don't think we've actually seen it wash through the market yet. I mean, we've seen some of our stocks that are exposed to the US dollar, I guess most obviously exposed, go up. But we've also seen some that I think will benefit a lot that haven't yet seen the price move a lot. And I think it's easy as an analyst to sit there and say, well, they earned this much revenue at this exchange rate last year and it's going to be this much at this exchange rate this year. That's the easy part of the calculation, but you're going to see a lot of Australian businesses that are a lot more competitive now than they were 3 years ago because they can sell their products cheaper and still make a profit. So you can actually get a lot of volume growth out of a lower exchange rate as well as just the translation effect, and I don't see a lot of people factoring a lot of that in yet. So I still think it's a good time to be invested in a few Aussie exporters, and particularly the ones that have got their cost base in Australian dollars and are selling in foreign revenues. We talked about the two of them 6 months ago, I think, but Hansen Technologies and GBST. We still like both of those companies despite the share prices being up a lot, and we think they're going to be able to compete a lot more aggressively for contracts with their cost base a lot in Australian dollars. So they're two companies we quite like. We've had a really good look at Australian vintage, some of the agricultural players. It's a really, really shockingly bad business, wine. So haven't really been able to pull the trigger on that one, but I do think the agricultural space is another one that's going through some interesting times and is going to be a lot more competitive at this exchange rate than previous ones.